Well, thanks for tuning into today's conversation. I'm your host, Neeraj Shah, and the markets have had a good run in the last whatever number of months that you can think of. And much like what the global markets are doing, which is climbing the wall of worry every single day, we've had Indian markets, particularly the broader end of the spectrum, doing the same. It's at times like these that we should try and talk to some of the largest money managers in the country about how is it that they are thinking about their investments into risk assets currently, and what is it that they foresee for the second half of the year, albeit the next, or in fact, the next 12 to 18 months. Sumit Jain, Deputy CIO of ASK Investment Managers, joins us right now on the show with his thoughts. Sumit, good having you. Thank you so much for taking the time out and speaking to us.
Same here, Neeraj. Thank you.
Sumit, how do you think about the markets from your prism as things stand currently? Because there are just a bunch of factors, as there always are, but just a bunch of factors impacting equities currently.
See, if you think about markets, over a long period of time, there have never been a time where things have not been uncertain. Last 15 years have been full of uncertainties. And I don't think that this uncertainty is going to end anytime soon. Yet what drives market over a long period of time is how are earnings shaping up? What is the quality of earnings? What is the quality of businesses that are reporting these earnings? And if you think about India, I think what India presents is the longevity of these earnings. Qualitatively, Indian earnings are significantly superior as well. So what we are seeing at the current point in time in markets is nothing but reflection of that. In fact, at the current point as well, if you think about earnings, I would think the outlook on earnings is kind of all right. There are multiple businesses that are actually doing all right. For many other industries wherein earnings today are slightly impacted, we are pretty confident that those are more temporary impact, and over period we'll start to see earnings kind of getting better in those areas as well. So markets actually are nothing but following how corporate earnings are playing out, and that's the way markets will kind of behave over a long period of time as well. So that's the way we think about markets and earnings.
Sumit, I was asking this a question to somebody yesterday as well. Did the post Q4 commentary from companies within your study landscape, and even not just the earnings call, but even beyond that, the interviews that we've done in the last few days of corporates, their optimism around operating leverage, margins, and earnings growth is visible. There are telltale signs there. Did that take you by surprise? Did you part anticipate this? Part one of my question. And part two of my question, therefore, do you believe that this skepticism around this 16%, 17% earnings growth might fade away, or will we see a scenario of an earnings pull back for the headline indices?
So see, I would actually agree with how earnings will play out probably in 24 or 25. See, if you think about 23 earnings, a lot of things actually impacted earnings. When Russia attacked Ukraine, quite a few commodities actually underwent a significant amount of downtick actually. Even now commodity prices are kind of correcting. And consequently, what happened also was many of the businesses actually saw significant impact on their margins because commodity prices went down and there were inventory losses on their books. So in next 12, 18 months, what I see is this thing actually will not play out. In fact, the way commodities are behaving, businesses which have relative pricing power actually have potential to report relatively better margin, and that will drive earnings growth as well. And on revenue front, I don't see there is a significant impact. So what we believe is earnings outlook actually is all right for India and corporate, and especially this is especially true for more domestic oriented businesses as compared to international. Internationally, there are, if you think about commodity prices, if you think about global commodities, if you think about IT businesses, the outlook there probably is a bit more mixed, and businesses earnings growth there is something which is going to be relatively more muted as compared to what we see on the domestic side.
Got it. So is it safe to assume, Sumit, therefore, that you might be more inclined towards betting, being overweight on the domestic focused themes currently?
Yeah, we in fact actually we have relatively higher confidence on domestic businesses compared to global cyclicals, global businesses which get impacted because of global vagaries. Because if you think about India and its long period growth, the confidence on India's consumerism, the confidence, the way premium consumption in India will play out over a long period of time. Right? The level of growth in those businesses actually will be significantly higher over a long period of time as compared to many other areas as well. So Indian consumers, Indian banks, manufacturing in India, I think these are areas where the confidence on earnings growth actually coming up is significantly higher, and which is why we have relatively higher exposure towards this part of the market as compared to the others.
Interesting. In some of these pockets, Sumit, I'd love to understand how you guys think about it. In some of these pockets, the valuations and the uptick in pricing because of one or two good quarters have really zoomed higher. Now, I would love to understand. Okay, let's break into buckets. Let's say, for example, discretionary consumption, right? Until 4 quarters ago, everything from hotels to multiplexes to urban discretionary, everything was available at a reasonable valuation or cheap valuations. Suddenly, that doesn't seem to be the case. The proponents argue that if you look 3-4 years out, 2 years out, maybe 18 months out, things look a lot more reasonable and the earnings growth will be strong. But the people who are skeptical say that the run-up has been far too sharp, too soon, and therefore it pays to be cautious. How are you thinking about it?
See, it's a function of your investment horizon as well.
Okay.
If you think about business from a very long-term perspective, what you need to focus on longevity of these earnings. Not only longevity important, but at the same time, what is the capital efficiency of these businesses? If capital efficiency is high, cash flows from these businesses ought to be significantly higher. And if those businesses are available at prices that you think are relatively reasonable, one can't get absolute cheapness in these businesses, but within pockets of these areas, actually you can find opportunities where pricing is a lot more reasonable relatively and earnings growth outlook is significantly superior. So that is the area where one should actually focus on. So the key is identifying longevity, identifying capital efficiency, right? That will drive valuation over a long period of time.
Where are you getting this mix? I mean, we obviously don't talk stocks as a rule, but I'm just trying to understand what themes, where is it within this pocket? Are you finding the mix of both longevity of growth and capital efficiency within this bucket?
So see, if you think about quite a few businesses like consumer electrical space, businesses there, I would think, are reasonably priced, and yet at the same time they have solid pricing power as well, which they have displayed. They are consistently increasing their size of opportunity, and consequently we believe that the valuation from the aspect of consistently increasing size of opportunity seems reasonable. So that is one area of pocket. Similarly, if you think about quite a few QSR businesses, the opportunity there is really, really large. And that is where we believe growth actually will be significantly higher and faster for a length of time. Similarly, some stable businesses as well are kind of fairly priced at the current point in time. So, overall consumption space, one can't be saying everything with the same thought process that valuation in all the areas are attractive. But yeah, you can find your own pocket of opportunities there.
Got it. Okay. Now, I obviously heard you say that IT is not looking that strong on the earnings front. I'll come to that at the end. I heard you also say that banks or BFSI might be strong. Now, my question is, within BFSI, one argument that is laid out is that if you're thinking of interest rate coming off, if not in 2023, then early 2024, then it's a pivot towards NBFCs vis-a-vis banks might be a prudent decision. I would love to understand whether you agree or disagree, why or why not. And if you do, how do you think about both of these pockets? Because they're very vast pockets. Even in NBFCs, a clutch of avenues open. In banks, a clutch of avenues open, and companies of very, very different kinds. And the grain within the companies are also very, very different. So how are you thinking about it?
See, fundamentally, I think from a credit side first, credit growth will continue to run higher than what our nominal GDP growth rates are. So within that, if one can identify businesses where the ability of management to kind of grow at a rate faster than what credit growth is, and report or show that kind of credit growth with respect to what the ROE is as well, and also credit cost, then what we get is a very decent business where earnings growth can be there for a length of time with a reasonable ROE. That is the pocket we are kind of focusing on. And I agree with your thesis that probably NBFCs should do much better than banks at the current point in time, given the fact that last year actually has been a phenomena where NIM expansion for banks has been reasonably high. From here on, we may not see pretty sharp NIM expansion, but for NBFCs, it could be a different scenario. So in many cases, we have reasonably higher exposure towards NBFCs as compared to banks. Having said that, it has to be really bottom-up businesses that we kind of look for, wherein the ability to understand their customers, ability to use technology well, those are the businesses where I think we ought to focus more on as compared to others. So what are those areas where you require relatively higher technology usage? Probably something like consumer banking, consumer finance. Right? Therein, you need to understand customer a lot better. There is a lot of friction there, and consequently, the usage of technology also has to be that much higher. So those are the areas where we are relatively more focused.
Got it. Any thoughts on non-lending financials? Are you constructive there or not really?
It has to be more case-to-case basis. It can't be painting everybody with the same brush, right? So there you will find host of businesses. Some can be insurances, some can be asset management companies, some can be wealth managers, some can be stock exchanges as well. So there are different business models, and every business model has to be looked at with respect to what is the kind of value addition that it does in the system. Some may be impacted in the medium term because of pricing pressure that we may witness, but in many areas there is a huge opportunity over a long period of time. Insurance is one area where we believe the opportunity from a growth perspective is reasonably clear from a long-term perspective, and there are not many insurances as well which actually can grow or which actually can increase market share from a long-term perspective. So clearly there are opportunities in the finance space or BFSI with respect to lending, with respect to non-lending, and so on and so forth.
Get the drift. A fair degree of fanfare around pockets which have been in hibernation for the past 12 to 18 months. In fact, getting into unloved themes which might be coming back is a significant buzzword. I would want to focus on two with you, because ASK in the past has had investments in at least one of them, which is specialty chemicals. The other is pharma. Both of them are correlated, wherein chemical companies are trying to do pharma APIs and vice versa as well. Would love to understand how you're thinking about both of these pockets.
See, I think the opportunity in manufacturing in India for India, and manufacturing in India for the world is for real. This is a pretty long-term theme. And if one can identify within chemical space in particular, if one can identify somebody who is really specialized, who works with client, there is a lot of R&D that is involved. And the relationship with the client is for a long period of time. One can say share within the client's opportunity size is really small at the current point in time, but can be really large. There we can get a lot of businesses where growth is a lot more certain from a long-term perspective. And we've seen in many of these areas, right, the kind of growth over last 4-5 years has been pretty solid. And that kind of growth actually is still possible in those businesses. So the whole focus in specialty chemical is in areas where R&D is significantly higher as compared to the others. So those are the pockets where I think the opportunity is large, and that is where we are kind of focused on. In fact, you touched about specialty chemical. I think it's part of the whole manufacturing in India theme. And when manufacturing does well, lot of opportunities actually start to come by. Specialty chemical may be one, but we would also look for opportunities in EMS space. That also is increasing pretty rapidly. There are other areas as well. So when we see significant amount of manufacturing, capital goods businesses will also start to do well. Logistic businesses will do well. Staffing businesses will do well. Consumable businesses will do well. So this is the whole bucket actually which sees significant benefit when overall manufacturing actually starts to do well. So the focus is not necessarily on specialty chemical, but the entire theme we believe is is poised for significant value creation over next many years.
Okay, awesome. I have a follow-up question on that because that's such a key thing in almost all global publications as well, which is this whole move of Apple doing what it is doing, maybe shifting manufacturing. We're seeing others coming in, and therefore the electronic manufacturing piece as well, right? It's growing in size. There is an ecosystem growing along with it. The stocks have done really well, whatever little is available out there. My question is, does this fit in the bill of longevity of growth and efficient capital allocation, or are valuations a big um, problem area because the starting valuations are probably not that attractive?
See, you will see in many cases where the businesses are just taking off. They are really, really small as compared to the overall opportunity size. In many cases, as well in the past, we've seen starting point of valuation actually not being very, very lucrative optically. In those cases, very rapid earnings expansion over many years actually will take care of the seemingly high valuation that we see at the current point in time. But for that, what is relevant is you need to identify entrepreneurs or managers who actually can execute really well. So execution prowess is something that you can't compromise on.
Sure.
And areas where this kind of gets altered, you will see significant value destruction as well. So you can't paint everybody with the same brush. It's all about execution, execution, and execution.
Okay, and in which case, my follow-up question and the final last couple of questions, or maybe the last question, is on this whole capex drive and the players associated. Because again, the argument out there is that the starting valuation is not that conducive. But here, the companies have proven track records of fairly decent management governance standards as well. And a lot of people who are bullish on this space, Sumit, talk about how the EBITDA growth in the previous cycles serves as a barometer of what could potentially happen in the current cycle. I'd love to understand again, are you guys looking at this theme? Are you constructive or are you negative? And why or why not?
So see, if you think about capital goods space in isolation, I think this cycle is going to be different as compared to what we saw way back in 2005, 6, 7.
Right.
At that time, all the investments were pretty significantly sizable, right? There were megalomaniac acquisitions as well. This time, I believe, cycle will be more about brownfield expansion, short cycle capex, smaller greenfield expansion, more with related to how one can increase efficiency, how can one increase automation. So it's going to be a different cycle as compared to what we saw at that point in time. While starting point in many of those businesses, I agree with you, is not lucrative, and valuations are pretty punchy. These are not new businesses as well. What we need to identify in this area is niche businesses. It can't be somebody who is pretty regular. Niche businesses which cater to specific demand, and valuations there are a lot more reasonable. See, this is in a way is a bit of a cyclical space as well.
Yeah.
While at the current point in time we are seeing solid business growth in this area, the order books are decent, but at the end of the day, at some point in time, this will start to peter off. So valuation will actually make a significant impact on the overall returns as well. So the whole thought is identify niche businesses where the strength is significantly large. And in capital goods, you can identify a lot of businesses which are pretty unique, where market share of those businesses is significantly larger in the overall schema of things. And that is where we actually would be a lot more focused on.
Got it. And you're finding such opportunities, niche businesses at decent valuations.
It's not easy when everybody kind of focuses on that area. But yeah, that's something we are actually really focused on.
Great. Sumit, lovely talking to you. Thank you for taking the time out and speaking to us today. And I look forward to talking to you more often on our platform.
Certainly. Thank you.
The pleasure was ours. And viewers, thanks for tuning into this conversation.